I'll be sharing with you the concept of hedging and how best you can apply it as a method of capital preservation in your trading for the long run. Now, if you're new to my channel, this is Foundation 28 Forex Hedging, where I teach the concepts of trading and other trading concepts that you need to also implement in your trading. Now, without further ado, I'll be jumping onto my screen and talking about the concept of hedging and how best you can apply it in your trading so that you can also see some changes in your trading. This is also good if you've already been trading for some good years and you have not been seeing results in your trading. This is one concept that you can also use. If you're a beginner, this is going to also save you the burden of constantly switching your strategies from time to time and allow you at least to master the concept of trading in the shortest time possible. Now, the concept that I've been talking about is called hedging. Now, with hedging, of course, we best define it as selling and buying of it's the same currency, not basically at the same price as I would have written there. Now, the concept of hedging is something that is mostly implied as a method of capital preservation, not necessarily as a way of making so much of profit. Now, hedging is something that you need to apply to your trading if you need to at least see that you do not lose your capital. And there is something that most beginner traders or even people who have spent years trying to master the concept of trading. Now, you realize that once you are in a losing streak, there is something that happens to you psychologically because you invest yourself emotionally in that trade, and the moment that you are in a losing streak, you will always be forced mentally, if you're not mentally strong enough, and you always have to take this initiative to always learn the kind of person that you are. Now, with hedging, you are going to be learning how to mitigate that risk, and the basic concept that I'm going to be teaching here is that how best can you use it to mitigate the risk and preserve your capital. Now, let's say that you are in a trade, and that trade you have maybe decided to take it to the you have decided to take a buy trade, and that buy trade is supposed to, maybe you have a target of 20 pips, and 20 pips is what you're targeting, and maybe your stop loss is about, let's say, half of that. I usually do a 1:2, so let's say you are aiming for 10 pips stop loss. This basically means that if price is to hit your stop loss, you're going to be getting out at a loss of 10 pips. Now, the concept of this strategy is that instead of using the 10 pips stop loss, you are actually going to open a hedge at this position. Now, you're going to hedge this position, and when you've hedged, you're going to be what you're going to be doing is now you're going to be mitigating the risk. And what you're going to do, you're going to hedge with the same lot size, the same lot size at that price, same lot size, of course, here. So let's say if you open the first trade with a 0.1, you are also supposed to counter it with a 0.1 lot size here. Now, how is this beneficial? Once you have hedged this trade, it means that this trade, you consider it something that is now a what? Something that has already lost, but however, you have not really gotten out of the trade. Because in some cases, what really happens is that sometimes you are wicked out because of liquidity. You are wicked out because of liquidity, or even what they basically call it, manipulation. Manipulation does happen. However, in most cases, if your strategy is already good enough, you really not have to worry about this about hedging, because what hedging does, it's that there are some other concepts that you need to learn early enough that once you've been hedged, you need to learn how to get out of a hedge. And that is where we talk about what they call trimming and rollover. And rollover. Once you learn about those two concepts, then hedging is going to be something that is a concept that you're going to implement immediately into your trading. Now, this is a concept that is not accepted by many pro firms. Of course, there are pro firms that don't allow hedging. Yet pro firms is something that we actually look up to when we are trying to build that capital that we are trying to, use to fund our trading. Now, the best thing that you need to do is, of course, do your research. And with my little research, what I've found out is FTMO, and there are basically just three pro firms that allow hedging. And the good thing, they are the major ones. And we have the fivers, and lastly, Funded Next. These are the pro firms that currently allow hedging. Now, if you're looking to build a portfolio, you know, for where you want to apply this concept, you can simply just use FTMO, Fivers, and Funded Next. They are the only pro firms that will allow you to do hedging on their platform. Now, brokers. With brokers, of course, all brokers allow hedging because it is I trading my money, and some brokers, yes, the concept of hedging, remember, you are not going to be losing money. However, of course, you're going to be paying for spreads and swaps. Nowadays, we have pro firms that do allow you to have a swap-free account, and they have very minimal charges when it comes to swaps. And then, of course, maybe there is the concepts of rollover. Those are all things, commissions. You need to learn about them in your early stages, in your first year, if you're serious about trading. Now, if you have learned about those concepts already, then of course, trading is going to be something that is, of course, very easy for you. Now, to learn about this concept, I will always recommend that you begin with not demo. I don't really like demo accounts in my life. And the longest time I've ever traded a demo account, of course, maybe if it's on a pro farm challenge, it's the longest time I've traded a demo account. However, I always prefer to use real money, and you can always use cent accounts. Now, cent accounts or micro accounts. Now, my recommended brokers that you can always use for now, I do use Deriv, I do use FBS, and of course, in my country, the best right now is XNES. XNES is known for the fastest withdrawals in the market, and of course tight spreads, and they do also have minimal. If you look for certain accounts, they have the least swaps that you can always use, because sometimes if you're a swing trader, of course swaps do accumulate and you do not want to be caught up in that saga. And this has been all. And lastly, before I do end this video, is I need to share with you my best way of how to track your or to get a portfolio for yourself is by using FX Blue. FX Blue is a platform that you use to actually keep a track record for yourself. Now, if you've been blowing accounts, now this is the time that you're going to stop blowing accounts. Always keep a track record, because you never know, at some point you're going to stop trading for pro firms, and of course you're going to be helping other people, and other people always, they do need what they call a track record. Now, if you have a track record, FX Blue is the best platform, alongside of course my FX book. You can use those two platforms to always get yourself a clean track record, get yourself good broker statements, and of course see that you can get investors from there. Now, this has been all for this video. This has been Enzo Foundation, and of course, my name is Foundation 28 Forex Hedging, and this has. Do not forget to also like this video, subscribe, so that I continue putting out more content alongside hedging. Now, do not forget to watch these other videos that I've put up here on my strategies on SMC. And this has been all for this video. As a foundation, peace out.